Investing in the stock market can be frightening for many individuals because we constantly hear about market collapses, depressions, and recessions on TV and the internet. But the majority of wealthy people continue to do so. So today we'll go over some of the most typical investing blunders as well as the key ideas that region-savvy investors employ. Many people make investments based on guesses. Investors concentrate on short-term gains enabled by market swings. For example, if there's a rumor that Apple is working on their next big thing, many people might be enticed to buy a lot of Apple stock. This type of investment is based on speculation, and it can cause Apple share prices to fluctuate and become a little more volatile because people may become eager to buy Apple stock in response to the rumor, potentially driving up the price of the stock and causing a bubble. If the rumors are true, other investors may be persuaded. If the rumors are wrong, investors began withdrawing their funds, burst the bubble, and lost money. A wise investor will buy stocks based on the price to value ratio, rather than speculation. When the stock price is below the company's intrinsic worth, their investments have a lot of room to expand. When a huge salad dressing manufacturer defaulted on its payments, Warren Buffett bought American Express stock. American Express stock price dropped by half. Although the corporation continued to operate normally, it only took a financial setback. Buffett recognized that the pricing was extremely low. As a result, he chose to invest $13 million in stock. That investment is now valued at $7 billion. Instead of speculation, smart investors like Warren Buffett employ analysis. All knowledgeable investors should follow three principles. First, before purchasing a stock, an intelligent investor examines the company's long-term growth and business principles. The long-term value of a stock is not arbitrary. It is intimately linked to the performance of the firm behind it. Intelligent investors look at a company's financial structure, leadership structure, and track record of profit distribution to shareholders. Intelligent investors don't get caught up in the trap of only looking at a company's short-term profitability. Instead, they look at the firm's entire financial history, which provides them a better picture of how well the company is doing, completely independent of its market value. This company, for example, is now not popular, therefore its stock price is lower, but it has a track record of good and consistent profitability and a solid infrastructure. Because the company is likely to be undervalued, share prices are anticipated to rise in the future. Second, an intelligent investor prioritizes protecting themselves against significant losses. They do this by building a diverse portfolio. One of the top investors in the world, Ray Dalio, is a great illustration of this. He diversifies his portfolio so well that he only lost 1.8% of his money in the 2008 market meltdown, when most investors lost up to 50% of their money. Do not put all your eggs in one basket, Warren Buffett advises. No matter how appealing it may sound, if you diversify, even if one of your investment fails, the remainder of your portfolio will compensate and the total portfolio will suffer less. Third, intelligent investors recognize that they are more likely to provide stable and consistent revenues than remarkable gains, because pursuing quick money in exchange for short-term advantages has a high chance of losing money, which they do not enjoy. Money mastered the game, according to the book. Tony Robbins interviewed 50 of the world's finest investors, and one thing they all had in common was a strong desire to avoid losing money. They also tried to find strategies to make the most money with the least amount of danger. The first thing to do before investing isn't to look at the stock's history, says Benjamin Graham. Sure, that's crucial, but it's even more important to consider the market's overall history. If you go back in time, the stock market has been defined by regular ups and downs, but market changes may be quite unpredictable, which is why wise investors must be financially and mentally prepared. Economic breakdowns like the 1929 Wall Street crash or the 2008 financial crisis are unfortunate, but they are part of a repetitive cycle that will continue to occur. This is why diversifying your portfolio is so crucial. so that your investments are not all hit at the same time. Furthermore, investors must be emotionally and psychologically prepared for a crisis because if they are not, they may sell when the market is down, locking in their losses. However, we can learn from history that the market always recovers, even after the most severe catastrophes. Intelligent investors, according to Graham, do not follow the herd. Sometimes the market is too optimistic, causing investors to see profits that aren't actually there. And other times, the market is too gloomy, causing them to sell everything. When things are going well, individuals begin to invest because it appears that everything is going well and that everyone will profit. This encourages other people to spend more money, and the market finally becomes unrealistically overvalued, resulting in an unsustainable bubble. Consider the early 2000s dot-com market bubble. Because the internet became a sensation, investors poured money into almost any tech business with a pulse. Many companies lacked the structure to become profitable, and when investors realized this, they attempted to withdraw their funds, causing the bubble to burst and many investors to lose money. As a result, intelligent investors do not follow the herd. When it comes to us, we have two options. We may be conservative investors, or we can become more active investors. Conservative investors often invest half of their money in less profitable asset classes, such as government bonds, and the other half in well-known stocks. Very conservative investors put up to 75% of their money in the safest, most profitable assets, and 25% in the riskier ones. In some other videos, I go over these asset classes in greater depth. So, if you're looking for something new, make sure to watch the video to the conclusion. Many investors now employ the dollar cost averaging technique, which is setting aside a certain amount of money to invest on a regular basis. For example, if you invest $300 every month, you will always invest the same amount, regardless of market conditions. If the market is rising, you will invest $300. If the market is falling, you will still invest $300. This method helps to limit volatility because when you invest in both up and down markets, the value averages out and you get a consistent growth rate that follows the market. You can put your assets on autopilot if you're a conservative or active investor. You can set aside a certain amount of money to be transferred directly from your bank account to your investment portfolio, and you should review your investment ratios on a regular basis. Typically, more aggressive investments grow quicker than less aggressive investments. So, if your 50-50 ratio is off, you'll need to shift funds from one side to the other from time to time. And this is what's known as portfolio balance. More aggressive investors use the same tactics as conservative investors, but they choose to divide their ratios more favorably in favor of equities, which have a higher growth potential but are riskier. They may experiment with greater risk and higher reward assets, such as startups in addition to bonds and well-established equities. No matter how exciting and tempting an investment opportunity appears, active investors should restrict these stocks to no more than 10% of their whole portfolio, according to Graham, for the same reason that a sensible investor reduces their possibilities of a large financial loss. Investing might be perplexing, but by grasping the fundamentals, you can be well on your way to being a wise investor. Thank you for watching. Don't forget to subscribe, leave a like, and comment down below what you would love to see next. And I'll see you in the next video.